What do you think is going to happen in 25, 26?
The numbers are staggering in some of the West Coast markets in particular. That we take identified construction from developers. I mean, you could see north of 50, 60% of what was supposed to deliver in a given calendar year can push into the following.
Welcome to the Gray Report. I'm your host, Spencer Gray. And whether you're an active, passive, multifamily investor, well, this is the show, the YouTube show and podcast designed especially for you. We're breaking down all the latest research reports, data, articles, and finding some of the best opinions from the multifamily industry. We've got a really special episode today. A guest on the Gray Report, Carl Whitaker from RealPage's is joining us. It's going to be a great episode. Let's just jump in. Let's get into it. All right, welcome to the show. Carl Whitaker is back on the Gray Report. Carl, we came on about a year ago, so it's a pleasure having you back on the show. How have you been doing, man?
Been good. Yeah, no, I appreciate you bringing us back on. And it's funny you kick off with that because I was going to ask you about how long ago it was that we chatted, because it feels like about a year, but I didn't know if that was
I was looking at it
or actual time.
Yeah, no, I think you're right, and I was looking at it too right after we made the appointment. It was just about a year ago. I think maybe a little bit longer. I think it was like mid-February last year when we touched base. And I'm going to be jumping ahead in some of the questions I wanted to ask you, but it's amazing, how much things change, year over year, in the economy, in the housing market. But compared to prior to COVID, going back, 2019 and earlier. And when did you start RealPage? Remind me.
So I started in 2016.
2016
acquisition. So
yep.
16, 17.
Yep. So you were there in the before time, before COVID. What was it like then? Putting out reports. And one of the reasons why we started doing this is because in our newsletters, because we felt like there wasn't a really great dissemination of the research, and there was great pieces that you guys were putting out, but no one was actually reading it. Now it's so essential to understand where the market is going because it's changing so quickly. So what are some of the big differences on, internally at RealPage? How are you guys looking at thought leadership, putting out research and reports now compared to in those before COVID?
Yeah, it's a really good question. And it's funny because we've had this discussion internally a couple times now. And I think the best analogy that I've heard is that pre-pandemic, our job felt a lot like being the weatherman or the forecaster in San Diego. The high is going to be 72, the low is going to be 60. There's a 20% chance of rain. It was so, I don't want to say easy, but you were basically just relaying 330,000 units delivered, 3% rent growth, 95, there was 95% occupancy. There wasn't anything necessarily newsworthy, if you will. Come 2020, obviously that changed quickly and sharply. But even 4 years later, almost 4 years later to the date, as a matter of fact, since the onset of the pandemic, we've really seen that each of the past 4 years has been anything but normal in comparison to the 2010 cycle. And each of those 4 years has been unique between themselves. We saw 2020, obviously the world's just trying to kind of find its footing. 2021, we had 2.5 years of demand that happened in a 12-month window. 2022, things are starting to kind of cool down, but then there's still some bifurcation of markets. 23 was, obviously the year where demand stabilized, but performance slowed down kind of counterintuitively. But that's because we're now at a 50-year peak in supply. And I think that that's really going to characterize 2024. But, just as you mentioned, it's just been it's been 4 180-degree turns in each of the past 4 years. It's made our job fun.
Yeah, no, I bet. I mean, I think it's a great analogy, the weatherman, because now it's like there's an extreme weather event that you guys are covering. And it goes from like everyone ignores the weather to you can't peel your eyes away from the weather. It's like there's a, tornado or hurricane going on and you're watching exactly what's going on, play by play. So that ties into my, my next question. Right now, your opinion is so important, and what you guys put out, with your colleague, Jay Parsons and other folks, colleagues throughout the industry. Because the global economy is looking at the U.S. economy. The trajectory of the U.S. economy is largely influenced right now on the direction of interest rates, you could say, and the direction of interest rates are influenced by, I guess, our perception in the market's perception of inflation, and our perception of inflation is largely influenced by CPI, of which 36% is shelter. And so, that puts, you and your colleagues in this position of having a really deep, niche understanding of one part of the market that is having, an asymmetric kind of influence on the direction of the economy. And so I think that, again, there's a lot of different factors that go into it. But given that insight, what you know about the housing market, what is your sense of inflation and the general kind of direction of the economy sitting where you're sitting and seeing through the lens that you see?
Yeah, I mean, you phrased it and summarized it there perfectly. It's just amazing when you start unwinding that ball of twine, how many things really revolve around, like you said, expectations of CPI, and 1/3 of that's explained by shelter. Just kind of using nice round figures there. One of the things we've seen is that, and for some of our viewers that maybe aren't quite as familiar with the CPI calculation, I'll kind of nerd out econ
Yeah,
wise here.
go for it. We nerd
Go
out
for it.
all the time
Okay,
on it.
so for viewers that aren't quite as familiar, the shelter component is basically a surveyed data point whereby survey respondents who are homeowners are saying, this is what I think my property would rent for, and then that's calculated year over year. So the change in that, I think I could, and I'm, again, just nice round numbers, I think I could rent my property for $1,000. 1 year later, it's $1,500, 50% increase. Now, those are just numbers for the sake of argument here. But because of that, you get a big lag in the shelter component of inflation versus what's actually happening. And with RealPage's data, we have monthly aggregated data that shows what residents are paying, both in terms of their new leases and renewal leases. And if you listen to the REITs earning calls, you may hear about blended or combined rent growth. That's effectively what that is in many ways. And that more real-time calculation shows that rent growth and rents have actually been slowing. And now at the start of 2024, new lease rent growth has been negative for 3 or 4 months now. And in some markets, that's been even longer: Phoenix, Vegas, Austin. But that's not necessarily captured in that shelter component. And then it's important too to remember that when assessing your rent roll, well, not only do you have the new lease residents, but you have your in-place residents too. And those rent growth changes are going to differ from that of what the market is bearing. So really all this to say, when you look at the more real-time rent stats, it shows that inflation is cooling more rapidly than what's captured in that overall headline CPI figure that you turn on CNBC each month and you hear about. And I think it's really important to note that, simply because the inflation number is cooling. Now, that doesn't mean that prices are dropping, as we all know. It just means that the sticker shock, for lack of a better term, of how fast those prices are increasing, that's starting to cool down. And last thought here, we think that's one of the big things that's translating to improved consumer confidence.
Mm-hmm.
And then that is also translating to some improvement in new household formation, apartment demand, et cetera.
It is interesting, the concept of consumer sentiment, because interest rates seem to be, not that they're so abstract, because obviously people have to deal with interest rates when they're purchasing a car or a home, and they're sort of aware of maybe what the APR is on their credit card. But it is really fascinating to see how fast interest rates can affect consumer sentiment. We saw it back in 2022, when we really started seeing, in combination with supply coming online, but certainly there was a direct there was a correlation between demand and the way that interest rates are moving, and really that uncertainty of the economy, and putting off those large decisions, and with a little bit more confidence that Jerome Powell, I think, put back into the market, I think back in November, kind of indicating, all right, we're looking at some Fed funds decreases over the next year. There's a lot of questions about how many and when and all of that, but it seems to be enough, not only for market participants and folks in the real estate market, but also consumers, to get back out there and say, okay, well, I am going to go out there on my own and rent that first apartment, or move out and make some decisions. I think it's fascinating. But going back to the CPI and the methodology, just like you said, you see it on CNBC, and they're like, well, really hot inflation print, and you see, 10-year, treasury rates, spike up, and, the stock market moves one other way, millions, billions of dollars moving one other way based on that CPI print. But then, and I know that it's based on this lagging figure. And even when you go a little bit deeper, and then, it's a survey for individuals to say, what I would rent my house for if I was renting it. When we have all this good data that you all are putting out, and the Federal Reserve was looking at that data more frequently back in the pandemic when a lot of the government sources, stopped, putting out data, and so they've looked at this higher frequency data. They know it exists. That they are very aware of all of this, but what's the disconnect, you think, between the reality, what the market knows, and should we care about? I mean, it makes me wonder: how much should we care about CPI if it's just just headlines?
Yeah, I mean, the question should be asked. I think the good news is that the Fed isn't looking at that OER, owner equivalent rent,
Yeah.
or the shelter component. Thankfully, they're not looking at that in a vacuum. They know some of this more real-time data exists. And you'll have to forgive me if I'm sourcing this wrong, but I think it's Penn State University has an economics professor who has worked with some of our data and some other industry data providers, and basically come up with like an imputed CPI.
Okay.
Using that more real-time rent.
Yeah.
And I think the Fed is using that in some of their decision making. Now, the everyday consumer the everyday retail investor may not necessarily recognize that, which maybe comes with some challenges. But I think the good news is that the Fed is smart enough to have a good assessment of some of that more real-time data. Now, one thing that is interesting, kind of going back to the sentiment idea, is that the Fed, while they do have the hard costs, or not necessarily hard costs, but there's the hard side of what they're doing, the concrete side of what that actual percent Fed funds rate is, but there's also the soft side of what they do too. In other words, the sentiment driven side, just like you said, the Fed saying, hey, we're probably not going to increase rates any further in 2024. That gave a lot of confidence to investors. Even not saying, hey, we're definitely going to cut rents and here's how much by, just the fact that they said it's not any longer going up, kind of lent itself to an increase in confidence. So, it's really interesting because, like you said, there's more to it than just looking at that headline CPI number. I think it's still useful in many ways, but I do think that a level deeper of knowledge on that particular data point is really critical whenever you start getting into when you start getting beyond just kind of like your everyday, hey, here's the news headline.
Yeah, no, I think you're absolutely right. When you read or hear speeches from Federal Reserve governors, they understand that nuance fully. But it's more of a surprise that that slightly lack of nuance, because it's not too deep under the surface, that the CNBCs of the mainstream kind of financial media miss. But certainly they're going to drive more ratings with some of those higher inflationary headlines. Carl, on the piece that you wrote at the beginning of the year, kind of some of those trends for 2024, and some of those were modest at best rent growth, high supply, improving demand, wages growing. Anything, we're coming to the end of the first quarter. And I remember there were calls in fourth quarter for recession by this point in the year. I don't know what they were really exactly thinking was going to happen, but what if anything has changed, because things have been moved just so quickly these days? What if anything has changed kind of from that January forecast and take to what you're seeing today?
Yeah, what is that old saying? Economists have called 8 of the past 2 recessions, or something.
Yeah,
like
exactly.
that. It's just everybody keeps on saying, yeah, it's going to happen 36 months from now, and it never really
It's
does.
a recession is inevitable. It's just when. Yeah.
Exactly. And I think that that's a good assessment too, to know that, hey, these things do happen, but ultimately they're really hard to predict, and it's rarely ever what anybody thought would happen. It's always some sort of, I shouldn't say always, it's often some sort of shock event that was going to be near impossible, if not totally impossible, to account for. But
yeah.
Anyway, kind of a sidebar there. More directly to your question, I think the biggest thing that's changed in the January to March numbers is that, one, we're seeing occupancy has now held steady for its third straight month. Now, occupancy nationally is a little bit lower than what we've been used to seeing, 94.1, 94.2%. But I think the fact that occupancy has fully, or I shouldn't say fully, now that occupancy has held steady for 3 straight months at the seasonally weakest point of the year
Yeah.
for leasing activity, to me says that we're probably closer to the floor than we've been at any point in the past 18 months. Now, that doesn't necessarily mean that this is going to be a year of excellent rent growth by any means. I think a lot of groups are going to be pretty pleased if you're in 1 to 2% rent growth, just knowing how much supply is delivering. But the good news is that, again, I think occupancy appears to be stabilizing. That's a big narrative change from even the January numbers, where we just saw occupancy had held steady for 1 straight month. I think the biggest narrative change, though, and I'm going a little bit out on a limb here because I don't know that I have a strong opinion on this, but I think the biggest narrative change is that it seems like those interest rate cuts that were hoped upon
Hmm.
this year may not happen as quickly as some had hoped, nor to the degree that many had hoped. You start looking at some of the underlying economic data that, again, the Fed would be using to make these decisions, and the economy is running a little bit hotter than I think they would like to see, while also generating or leading to a rate cut. So I think the biggest shift thus far might just be that sentiment that improved last year by signaling rate hikes aren't going to go, or rate hikes aren't going to happen. I think some of that sentiment may have cooled now on the flip side of that coin, because there is a growing sense that those cuts might not happen to the degree that was initially hoped.
Yeah, I think that's a really good point, and that's kind of a more recent shift. I'd say the last we've had a hot job report a couple weeks ago, and then CPI that came out last week that we were just talking about, and it's interesting. Just internally at a Monday meeting today, I was talking with some of the team, and there was a piece that came out about John Gray from Blackstone, and I think Goldman Sachs, basically calling more or less with a bottom in the commercial real estate market, or we're nearing that bottom point. All I could think of was, though, that I'm sure this was written 2 weeks ago when the 10-year was basically at 4%, and we were all looking around like, okay, if things are softening, things are moving in the right direction. And then I look around on just like the last week on Friday, and the 10-year is back at 4.3. Now, some of that is based on that CPI report that we were just talking about, that had that higher print, and some things are running hotter. But it also maybe scratching my head because, of course, there's that higher headline number that has highly weighted towards shelter. But yeah, I think that you're right. I don't think that there were talks of rate cut in March, and I just don't see how the Federal Reserve can justify that when the economy still is running quite hot. It still seems, though, that we're moving in the right direction. They've communicated that we don't even need to see a big change in the data. We just need to see more data of the same and just a continuing trend line, which it seems more or less that we're seeing. But politically, it would be hard to start moving when it could be hard to argue that we're in truly restrictive territory. When the economy is still going so strong. But it's we'll check back in 3 weeks when the 10-year is below 4%, and it'll be right back on track. You mentioned supply a couple of times. It's one of the biggest factors right now, kind of affecting the multifamily market. But there's some short-term and long-term trends are all kind of converging at the same time. On one hand, we've got a housing crisis. We don't have enough housing units in the United States, but we're building too many housing units all at the same time, of the same high-end luxury stock in the same Sun Belt markets. Also, at the same time, we saw above trend, almost record absorption in Q4. As you mentioned, that's supposed to be like the slow season, which we saw anecdotally in our portfolio as well. Try to help me make sense of all, starting with kind of supply. Where is it concentrated, and what are the markets that you're concerned about? And then also, what's it going to take to get some of this absorbed?
Yeah, it's so funny because all those things you said are true in their own right. We are in a housing shortage, but then we're also delivering too much supply over a
Yeah.
1 to 2 year window. And like you said, it's all concentrated in certain markets because Cincinnati isn't necessarily dealing with, a 50-year peak in new
Yeah.
construction. And, it's so funny because all those things you said are true. And when we talk to groups, a lot of times we'll share a national number and they'll say, well, that's not what we're experiencing. And
Yeah.
it's
Of
like, yeah,
course
we're
it's not.
not. Yeah, exactly. We're not trying to say that everybody's experiencing this. We're sharing broader opinions. Um, but I do think that, like you said, the supply peak that we're seeing today, it is a very real phenomenon. We are scheduled to deliver in 2024. RealPage shows about 680,000 new apartment units, which would be the highest we've seen since 1972.
Yeah.
Just
Wow.
an immense number. Now, on one hand, 680,000 units today, if you look at the working age population, if you look at what percent 680,000 of today's
Yeah.
denominator
Relative.
is relative to 72, those are very different numbers. And
That
I
makes
think that's where
sense.
we need to be a little bit, I don't want to say cautious necessarily. I think you just have to understand that context of, 600,000 units today versus the early 70s, very different in many ways. But nevertheless, we are seeing supplies impacting rent growth, occupancy. It's impacting operator behavior and preference, where the kind of the mantra at the beginning of 2024 is heads on beds. And I think the best summary that I've seen is actually in some lease up data that RealPage tracks, where we look at just at the lease up or properties in lease up alone. And the two data points I'll share that have been fascinating: the number of lease up units absorbed in 2023 was actually higher than the number in 2022. And 2023 was higher than 2019. So not only did it improve year over year, but it was almost like hey, this is better than what it was going into the pandemic. Yeah. Now, the difference is that we also delivered a lot more lease up units last year. So when you look at that on a per property per month basis, one thing we're hearing is operators saying, well, it doesn't feel like the traffic is out there. The traffic's out there. It's just that one renter is now shopping 4, 5, 6 properties. And again, this is exactly what supply is supposed to do, and where it does actually alleviate some degree of affordability challenges and supply availability crunches, I should say.
Yeah.
So, we're actually seeing that the per property per month basis on lease up assets, or the absorption rate per property per month, kind of a mouthful there, that number has come down, and that's because of supply. Now, the other thing that I would mention is that, again, this is impacting the approach to the market, and we're seeing that asking rents, not even effective, but asking rents among these lease ups are leasing today at the same rental rate as September 2021. For folks that aren't as familiar with the lease up space, that's really surprising, because in theory, lease up rents should always just go up by the time you take into account the basis of construction and what it costs. But not only are developers looking to lease these things up as fast as possible today, partially to get out of that higher interest rate construction loan and into a stabilized loan, but the effective and the asking rents have reverted back to a 2-year prior level. And again, it really shows you the impact of supply. And we are actually seeing, last point on supply, just this is kind of like,
no, it's important
of the year. Some of these neighborhoods, I'm going to pick on Austin, for example. North Austin, which is seeing 10-15% of its existing inventory deliver over the past 12 months, it's actually Class C rents that are seeing the biggest cuts, followed by Class B, followed by Class A. And you would think, hey, if all these are delivering at a Class A price point, wouldn't that product class get hit the hardest? But I think we're actually seeing some upwards filtering of renters, and how the impact of supply, today's A is tomorrow's B. Well, in the Austin example, the 2018 product that delivered in that specific submarket is now Class B. I use Class B in air quotes because Class B
it's still nice.
Austin is still really nice. Yeah, that's very different than Class B in Youngstown, Ohio. So anyway, that's just
no. I was gonna. I'm so glad you brought that up, because I was gonna ask you about that as a follow up, and I think it's maybe one of the most interesting outcomes that I think could be really truly important for the industry and for policy going forward, because I think it's a really solid data point that we haven't had an opportunity to have, of showing of how new housing stock of any kind, luxury, can still lower the cost of housing and make housing relatively more affordable. Rents in Austin still aren't affordable necessarily, probably,
Right.
but it does have a softening effect on the market. That I would hope that policymakers in the future would latch on to, with the idea of we need more construction, kind of the moving towards some deregulation of allowing more development, rather than being really choosy on exactly what we're going to build, because then nothing really does get built. So talking about supply, there's a difference in opinion between RealPage and Yardi, and I saw the debate at NMH, not really a debate, but I was at NMHC, and I watched Jay Parsons, your colleague, talk about the difference between RealPage's and Yardi's kind of data. There's a difference of opinions on how much will be delivered in 2025 and 2026. Yardi has a much higher estimate than you all do. I think they're in the, I want to say 390,000 units delivering, I think, in that range. Curious what the difference of opinion is, your thoughts. What do you think is going to happen in 25, 26?
Yeah, and thanks for the backdrop there, just because I wasn't sure what the exact number was, or like the range, if you will. So one of the things that RealPage data does is that we take identified construction from developers, we're surveying them and saying, hey, the 300 unit property that you have in Las Vegas, when do you expect your first move in? When do you expect to be stabilized? And then we can kind of build a delivery schedule from that.
Yeah.
Now, granted, these are all just best guesses given to us from the developer, and delays are inevitable. We've seen delays have been more common, as you would expect, over the past couple of years. And truthfully, in some of the West Coast markets in particular, the numbers are staggering. I mean, you could see north of 50-60% of what was supposed to deliver in a given calendar year can push into the following. It's incredible, and that becomes a domino effect. It's hard to get back on track when you start getting delayed. But nevertheless, our data showing 680,000 units in 24, that doesn't take into account any delays. So I think realistically what will happen is, call it 15 to 20% of that expected number pushes forward into 2025. And what will happen is the 24 and 25 numbers will look less like a, kind of like my fingers here, it'll look less like a peak and it'll look more like a plateau. But by 2026, we actually do expect that the numbers come down pretty substantially. And the reason for that is, based on RealPage data, 380,000 units started in 2023. And our definition of start, meaning that, they've gone vertical, essentially. It's not like a planned or a pre-planned number.
Starting to build it.
Yeah. So you're physically moving that building, or starting that building. So the 380,000 started today. Well, even a simple back of the napkin math would say, okay, push that out 2 years and there's 380,000 units. However, by the time you start taking into account, well, some of those will deliver 3 years from now. Some of those, it's not going to be all 24 months. So that's what feeds into our expectation that you actually do see the realized deliveries pull back substantially. And just to give one more number here, 380,000 units started in 2023 was the same amount roughly that started in 2014. So we've reverted to a 10-year low in starts. And if you look at the deliveries from 2014 or 2016 in this case, then it shows you about 300 to 350,000 units. So I think, or 250 to 300,000 units, that is. So I think 2026, you're really in that 250,000 range.
Wow.
Until something happens with interest rates and construction financing, which then maybe that goes up. And I have some data I can share on that, just to kind of help put hard numbers behind it. But
no, appreciate that. But no, that does make a lot of sense. And obviously, it's hard to finance new development right now. The debt and the equity is hard to come by. Assuming that or if interest rates come down, that will allow for the feasibility of a lot more of that development. And there's certainly developers that would like to be building new apartments, but don't have the funds to do it right now. So given that kind of delay in pushing off some of those deliveries and the slowdown, just speaking of the Sun Belt, because the Sun Belt is seeing the most supply pressure right now. Is it 26, 27 when you see, that absorb those new units to be fully absorbed and kind of back to normalcy? What's kind of the timeline? Because there's a lot of folks that, think about investing in the Sun Belt right now because maybe prices are low and you can get in at a good basis right now. But at the same time, how long do you want to wait? If you're in a deal right now, you're kind of sweating depending on how you financed it, and when are you going to get a little bit of reprieve? When do you think that the light at the end of the tunnel starts getting a little bit closer?
Yeah, I think 2026 is realistically when the Sun Belt on aggregate starts to reestablish its footing. Call it 2 to 3% rent growth can be expected
Mm-hmm.
again. I do think there will be some markets that overhang goes a little bit further. I
Mm-hmm.
would call out Austin, for example, where it's something like 15% of all units that exist today are under construction. So a market like that, sure, the absorption's strong and maybe one of the best numbers in the country, but to borrow a phrase, the best way to eat an elephant is one bite at a time. That's
Mm-hmm.
what it's going to be like working through a lot of the supply in those really big supply markets. It's going to take 2 or 3 leasing cycles to do so. So I think Austin, Raleigh, a couple of others that come to mind, downtown Nashville, I think 2027 may be a more realistic target.
Yeah. And it begs the question, because such of the interest in multifamily for multifamily investors over the last decade has been the Sun Belt. It's been those markets. It's been Austin, it's been Raleigh, it's been Charlotte, it's been Phoenix, it's been Atlanta. With, call it, 2 years of questionable growth prospects. Now, again, you might be able to get a good discount right now, which could be a reason all in itself, because then you get the growth in the future.
Mm-hmm.
Where do you see, I guess, do you see investment trends, I guess, shifting away from, I'm not entirely leaving the Sun Belt, but I guess looking for different markets, different regions, different strategies? Where do you see that?
Yeah, I do think that will be something to keep an eye on. One of the things that I've seen, and this was already kind of happening pre-pandemic, but I think it could be the conversation could spur forward over the next 2 or 3 years, are the second ring Sunbelt markets.
Mm-hmm. Yeah,
Historically, somebody looking at, and I think you and I actually talked about this
I think
last
we
time
did. Yeah.
we were discussing,
I'm
but
always asking about the Midwest and, when can we get some more credit, even though that's not the question I just asked, but yeah,
well,
sounds about
that's
right.
actually the follow up I was going to say to this
Okay.
answer.
Okay.
But
Yeah.
for folks looking in the Sun Belt that historically said, "Yeah, Nashville's where I want to be, Charlotte's where I want to be," I think the conversation now starts to become, maybe Knoxville makes
Yeah.
sense, maybe Greenville, South Carolina makes
Yeah.
sense. The areas that you maybe wouldn't have considered previously, because you still get the Sun Belt story, you still get the Sun
Mm-hmm.
Belt growth, but you're not dealing with 15% inventory
Yeah.
under construction. So I think
Yeah.
that is something to keep an eye on. I do also think too, and I haven't looked at any data on this, so this is purely conjecture, but I wouldn't be surprised if you start to see a little bit of capital reallocating towards the Midwest. And I think a lot of people are seeing over the past 12 months and for the next year or two at least, that slow and steady wins the race story that the Midwest offers can make an attractive investment opportunity. It might decrease your liquidity a little bit. Maybe there's some other ancillary factors to consider, but you're also not dealing with as much expense growth as you
Yeah.
are in, say, Florida. Um, you're not dealing with the supply pressure that you're dealing with in, say, Texas. And, the market seems to be in pretty good shape. And I think that a lot of the Midwest markets, I think, and maybe this is just my perception coming from a Texan, but I think oftentimes when somebody thinks the Midwest, they think Cleveland or Detroit
Yeah.
or,
Yeah. Rust
Youngstown.
Belt, right?
Exactly. And
Yeah.
people think Rust Belt is congruent with
Yeah.
Midwest when really that's not the case. The Midwest has other markets like Columbus, Ohio, that actually kind of have a vibrancy and offer upside while also maintaining a relatively high floor. So I think you're going to see the Midwest kind of come back up in some conversation. I don't necessarily think the Northeast will see as much of that conversation
Mm-hmm.
because the barriers to entry are quite a bit higher.
Yeah.
And I do think that there are some legislative concerns among investors. Not to say that it totally, it doesn't just totally throw the investment thesis out the window,
Yeah.
but it makes it a little bit tougher. So I think the Midwest kind of gets the best of both worlds in that regard, where you've got low barriers to entry, but also the stability.
Yeah. It's fascinating, because the big I guess, argument against, the Midwest or smaller markets is the liquidity, question, because it's a fraction of the liquidity of, some of the major markets. But, I find, unless you're a Blackstone, you need to place, $1 billion worth of capital, usually isn't that big of an issue. But certainly there are players like that institutional players that it just doesn't work for. The other piece is, manufacturing is coming back in the United States, with reshoring. And, it seems like every other week there's a new, whether it's a battery plant, semiconductor foundry, or, something related to advanced manufacturing that's popping up, whether it's in, Columbus or Indy or Cincinnati. So it's pretty interesting to watch. And also, I guess, this is another topic, insurance and expense inflation has been affecting everyone in the country. Everyone's heard of inflation, whether it's contract services, wages, utilities, but, insurance has been, absolute albatross. And for Florida and Texas, I mean, in Indiana, we've seen insurance increase, double over the last couple of years. But at least it hasn't tripled or quadrupled. We don't have the extreme weather events like they do down, especially near the coast and the Gulf Coast. But I think it'll be interesting to see some of those just trends over the next decade. You heard anything on insurance? Because, it's one of those things that it's such a challenge to figure out, and it's a headwind in addition to the supply pressures, and interest rate issues that we're seeing today. Any I guess hearings of any reprieve for multifamily investors on the insurance front?
I mean, the only thing I can share is the data that we have supports that exact idea that, insurance costs have been a massive headwind for operators. And, I'll kind of go back to what we kicked our conversation off with, where the market research side in the 2010s was kind of boring.
Mm-hmm.
More recently, it's been a lot more interesting. Insurance folks kind of are seeing the same phenomenon where, an insurance session at a conference maybe had 10 people in attendance.
Yeah.
Well, now the insurance session's like the sub headlining
Yeah.
session.
It's make or break it.
Reason.
Yeah. It's fascinating. Okay, I'm shifting gears a little bit. This is something I've been interested in personally, more recently. And it's not political at all, right? Do my best to take the politics out of it. It has to do with immigration and illegal immigration. Again, it's neither here nor there. But the fact is, there are a lot of people and more people coming to the United States. The people have always been coming to the United States. It's harder to track. There's not always great data. One of the biggest headwinds for the U.S. over the next couple of decades is, possibly declining population, reduction in fertility rates. The thing that could save us if we need saving, or I guess depending on your opinion, is increased population growth is good for the economy. It's good for real estate. So people coming to this country, again, take whatever opinion anyone has. How do you take that into your data? When you're putting these forecasts projections in, there's reports that there's a lot major increase in immigration over the last couple of years. How do you factor that in? I'm just curious your thoughts of how that will affect the market over the next several years.
Yeah, I mean, right now is the time to be having that conversation, because we're seeing it come up, not only in conversation, but like the physical data is supporting that.
Yeah.
Hey, we saw the immigration. I think John Burns Real Estate put out some good research.
They did recently,
weeks ago, that showed that I think 2023, if I remember right, was like -- year ever for net migration.
Yeah.
Or net international migration, I should say. So we don't necessarily forecast. Our forecasts only go 5 years, so you kind of have a narrow band of migration expectations. But I do think that if you're looking 15 plus years, then the population pyramid based on domestic births versus domestic deaths, pretty simple math tells you, hey, you either got to have more births or you got to be bringing more people in. And that's a conversation that, again, needs to be had. I do think that if there is a short-term impact of international migration and where it matters the most, I think that that's going to be on the coastal markets, DC, San Francisco, Seattle, New York, Boston, etc. Historically, the areas that were getting a lot of international migration, it appears that those markets have seen international migration returned to pre-COVID norms.
Hmm.
However, on the West Coast, it appears that the net domestic migration is still resulting in some challenges. So the international increase isn't necessarily enough to make up a big deficit, or it's not necessarily being supplemented, I should say, by inbound domestic migration.
Okay.
Conversely, a
Yeah.
Houston or a DC, I think you're getting both domestic and international migration. Florida,
Hmm.
pick your market, and that statement holds true. So I do think that some of those markets, the ones that were mentioned, maybe get a little bit of additional near-term bump because the domestic and international
Yeah.
migration numbers are resulting in a combined, a combined lift.
Yeah. California is too expensive, whether it's for, I guess it's for, domestic migration or international
Yeah.
immigration. It's expensive. Beautiful place, but it's a little.
Well, and you think too, a lot of the areas that were historically the destination spots, oftentimes not necessarily the suburban areas that were
Mhm.
way outer lying of these metro areas with more remote work and stuff. There's just not as much of there's not as much of a reason necessarily to tether nearby to, say, an office
Yeah.
location. So I think that that's another thing that kind of makes the near term outlook a little bit cloudier in your true urban cores, not your quasi urban core a la
Hmm.
Dallas, but your
Yeah.
urban core of San Francisco or
Yeah.
Seattle, etc.
Yeah. No, that makes a lot of sense. Carl, I'm curious, anything that you're working on right now? I guess any new articles or research that you're working on that we should be expecting to see soon that you're excited about?
Yeah, so next week, or the week of March 25th, we have our student housing overview. I don't know if any folks here are active in the student
Yeah.
sector, but we do
Sure.
that once a quarter. And, I think that the student sector can actually tell you a little bit too about the overall direction of A, the economy, but B, just the health of the housing market. I think most importantly, though, in mid-April, we'll have our second quarter US outlook where we review first quarter stats
Hmm.
and look forward to the rest of the year. I'm really, really curious what the March numbers say in terms of occupancy and rent growth, because again, thus far, it seems like we've found the floor in terms of rent growth on those new leases. The occupancy numbers have been steady, so maybe some of that seasonal lift that you would expect in March, if that goes up a little bit, then I think maybe we've got some better sentiment brewing
Yeah.
around the state of the market. But we'll see. So I think that those are going to be the two big things that we're keeping an eye on.
Cool. So, seeing that there's a trend, in the data with some recovery and a bottoming out.
Yep.
Any advanced takeaways from the student housing piece? Too early, or anything?
No, it's
No.
funny. We are talking about a 50-year peak in new supply. Student housing is really seeing the total opposite, where expected deliveries in 2024 are basically the lowest we've seen since 2010. And I
Mm.
think a lot of that is, with student, there's an inherent level at which you've overbuilt the school because your demand
Yeah.
pool is
There's only so
fixed.
much. Yeah.
So, and I think that we saw some schools get overbuilt in the 2010s. Mississippi and Missouri in particular come to mind. Those two schools are kind of interesting though, because their year-over-year rent growth today and their pre-lease occupancy today, those two schools are like in the top 15 nationally, despite seeing rent cuts for the past few
Interesting.
years. So to me, what it says is that if a school gets overbuilt, that isn't necessarily a forever doom and gloom scenario. They
Hmm.
can recover, but it takes them a little bit longer. And I think maybe some of these areas that we've talked about in the Sun Belt on the conventional side will be a little bit of a corollary there,
Yeah.
where downtown Nashville, it's hard to expect a scenario where you see positive rent growth in 24 or 25, but maybe that extends into 26 because 40% of downtown Nashville is currently under construction.
Yeah. It's wild.
And so I think there's going to be some instances of that where it's a tough 3-year outlook. So anyway, I think that's where the student numbers can actually kind of give you some interesting comparison points, if nothing else.
Yeah. Well, it's important to study what's going on in the student space because those students are going to be your newest market rate
Yeah.
renters in just a couple of years. And we've seen the the trends in the, I guess, what the kind of amenities, a student renter is looking for based on all the bells and whistles and the fun stuff that they see at the student properties. And then at the new market rate properties, we have to start adding all the cool stuff as well. So Carl, last question, just real quick. And I'm just curious, your colleague Jay Parsons, he's made a huge following over the last year and a half. I mean, he's created an incredible thought leadership program and platform over at RealPage. People are really listening and watching what Jay Parsons. I mean, I wait for Jay's and yours posts on LinkedIn. I'm like, to see hey, what's going on, to get your guys' takes. So incredibly valuable. Jay is stepping, or he's moving on from RealPage. I understand. I'm sure. I don't know if you're all privy. Any insights? What's Jay? What Jay's going to be up to? What he's doing? Any liberty to say anything or mention?
Absolutely. Actually, Jay texted me about 30 minutes before we hopped on the recording here. Jay, just kind of a quick sidebar. Jay's been a mentor to me for the past few years at RealPage, and he's somebody I view as a friend, even beyond just the mentor colleague perspective. So he's always been fantastic to catch up with, and been a truly wonderful mentor. So he's currently serving as the chief investment officer of a group here in Texas called Madera Residential.
Okay.
And don't quote me on, well, I'm on video, so I guess I am going to be quoted on this, but
we won't. We get it. Yeah.
I think it's about 30,000 units. So they've got a sizable
that's awesome
portfolio. It may be getting close to 40,000 units, but they're based out in West Texas.
Okay.
Which, funny enough, but they have an office in Dallas. So he's still going to be doing his thought leadership. He's still going to have that national mouthpiece, and it is, to your point, really, really valuable insights for the industry, even beyond rental housing. Just for just housing in general, and kind of talking about our inflation discussion earlier. I think Jay was one of the first ones that was really harping on the impact of shelter on inflation. So he's been brought into a lot of even policy discussions, not necessarily with the Fed, but his insights are getting disseminated and used well beyond just your day-to-day rent growth and occupancy stats.
Well, your insights and Jay's and others, but especially you two, have really helped increase my knowledge over the last couple of years, and especially since the beginning of the pandemic, which was around the time when we started our Gray Report newsletter, which focused on research, and this podcast and YouTube show. You guys have just been an incredible resource for us in the industry, really disseminating that knowledge, and in a space that hasn't always been as efficient at doing that, and for a variety of reasons. And so we really appreciate it. I'm glad that everyone is giving you guys the proper attention that you guys deserve for the work that you guys do, because it's so valuable and so important, like I said earlier, to the entire economy. So just, again, thanks for all the work that you guys do, and really appreciate it. And Carl, thank you so much for coming on the Gray Report.
Yeah, well, thank you for the kind words, and always a pleasure, and look forward to joining you again soon.
Yeah, let's do it again soon. All right. Thanks again.
Thanks.